I do want to get your take on the jobs report. We had that stronger than expected addition of jobs, but of course the unemployment rate ticking up. And if you dig below the hood, a lot of mixed messages, I would suggest.
Yes, as you get from time to time between the two surveys, the establishment survey and the household survey, the establishment survey definitely very solid, somewhat stronger than expected, whereas the household survey was much weaker. But generally, I think you should put more weight on the establishment survey. So overall, I would say this was pretty solid.
So pretty solid. Do you feel like the labor market is showing the slightest, most tentative signs of the effects of the Fed's tightening campaign based on this report today?
Well, there has been a deceleration in employment growth as we've gone through the year, from extremely strong rates of job growth to merely strong rates of job growth. The other thing to focus on, I think, is the wage numbers. While today's number was a touch stronger than consensus expectations, if you look at different indicators of wages more broadly over the last several months, there's been a deceleration in wage growth. And that's what the Fed will need to see, because they're worried that wages are growing at an unsustainable pace. So the average hourly earnings numbers now 4.7% year on year. That was in the fives not long ago. And if you take a shorter period, last 3 months or so, then actually we're seeing ongoing deceleration.
So you were pretty early in what's now becoming consensus slower for longer trend in terms of getting to a terminal rate. But this week, Bank of England said maybe over there the market's pricing in too much. Is there any sense that we might be doing the same?
I wouldn't necessarily say the U.S. is pricing far too much. I mean, our terminal rate estimate is a little below 5. Market's a little bit above 5, but I wouldn't argue strongly against that. I do think that both the UK and the euro area are just in a different situation. I mean, the economic outlook there is a lot weaker, and in part because inflation is still accelerating there. I mean, headline inflation is still going up, so the drag on household income in both Britain and Europe is still increasing. In the US, while inflation is still very high, it has been coming down somewhat, and that makes a pretty big difference.
Right. Are there risks to CPI in the next few days, especially given that energy's going to be higher for the first time in 4 months?
Yes, I mean, energy should contribute positively again, so the core should be somewhat above the headline should be somewhat above the core this time around. There are some other areas where you might see some deceleration, though. The healthcare area, I think, on the core side should be a little bit softer. And then we should see really some of the durable goods price indicators come down. Used cars are a great example, where auction prices have been falling pretty sharply, but only a small part of that has shown up in the CPI so far.
So just looking around the world, I mean, depending on who you speak to, China's arguably in a recession. Europe, arguably in a recession. Can the U.S. avoid one? Even with the Fed doing what it's doing, if the Fed is able to, just from its standpoint, try and engineer a soft landing, if you look the globe over and you see this economic decline happening, can the U.S. avoid it?
I think in principle, yes, because there are a lot of different things going on in different economies. China, still dominated really by zero COVID, lockdowns, restrictions, the emergence from that. That's, a thing of the past in both the U.S. and Europe. Europe is seeing this, very large energy shock from natural gas that doesn't really exist in the U.S. So while that doesn't guarantee that the U.S. can stay out of recession, our estimate is that, it probably will.
Shepard Smith here. Thanks for watching CNBC on YouTube.